Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra. With me is Ekta. You're tuned into your stocks and we have lots of queries which have come through. But first up for the markets, it's absolutely flat right now, just about holding in the green with a 10-point kind of gain. We have lost around 50 points from the top of the session, but there's been a decent recovery from the lows as well. So do keep that in mind. The good news is that the broader market is really holding up much better today. So while the mid caps are just around, 0.3% in the green, the small cap index is doing quite well, up around 0.8%. But Ekta, there is definitely some caution considering the number of queues that are lined up this evening.
Hi, Pavitra. Yes, absolutely. And the cues from last evening as well, which was quite disappointing for a couple of these stocks post the GST meet. Yeah. And yes, we do have the CPI data from India as well as from the US, which is lined up. From India, we are expecting hardening to take place. 4.6% is what the poll is. But in the US, it could be a sub 4% figure. So that could be something that the street would take with both hands. So a lot lined up in terms of cues. Not to forget, we do have all of the IT numbers to reckon with as well. Joining us this afternoon, we have Rajat, Bose on the technicals and Sharad Avasthi, who is joining in on the fundamentals to answer all of your stock queries. Rajat as well as Sharad, thank you very much for joining in. Well, let's get to the first question. We have Saira, who writes to us from Aurangabad. She holds 50 shares of HUL, which is bought at around 2,575 odd rupees. So she's in the money here. She's a medium-term investor and wants to know what to do, whether to hold or sell at current levels. Well, Sharad, let's start with you with your thoughts on HUL. In the money right now, but do you think that it would be an investment that one would hold on to?
No, I think the expectation is 10-15% kind of growth, and she is talking about being a medium-term investor. The stock is already trading at around 48 times forward earnings, 2-year forward basically. So I don't think that there is much scope of re-rating in the stock from current levels. Minor re-ratings could happen because of lower raw material prices and some rural India uptake, but that wouldn't be material enough to make me bullish about the stock trading at already 48, 49 times. Maybe with some upgrades, it comes down to around 45 times FY26 earnings. So I think it's on the expensive side. It's better to switch on to something else, something like an Imami probably, where the valuations are very attractive, or a Bajaj Consumer, where there is a possibility that they could grow at a much faster clip going ahead with new products being added to the basket and faster diversification and growth strategy.
Okay, got that. Let's also ask Rajat what he thinks about HUL. Rajat, the stock is not too far away from its all-time high, but it's really not done much this year, right? What do you think about this stock just on the technicals?
See, from a technical point of view, if you look at the long-term chart, I would say that this is a kind of consolidation come absorption of supplies at the current levels, because once there is a decisive breakout above 2700, then the stock can move up further. It can go up to something like, in my reckoning, initially the target would be 2836, and after that it can even test 3000 levels. But I broadly agree with Sharad that immediately maybe there would not be much of an rise. But if a person is a long-term investor, I would suggest don't get into something else which may not be of this great quality. The HUL, you can stay put. Even in a downturn, it won't go much further down. And then when it bounces back, it will be one of the best bouncing back stories. So long-term investors should stay put, but medium-term investor may use a stop loss, and that stop loss could be something like 2647 in my reckoning.
Okay, all right. Stop loss could be 2647 for HUL. But we have another query, and this time from the FMCG space itself. Shrikant writes to us from Mumbai. He holds 2100 shares of ITC, which he's bought at an average of around 190 rupees. So sitting on a massive profit there. He's a long-term investor and is ready to hold for the next 5 to 7 years as well. He wants to know what the strategy should be. Should he adapt to maximize the profit as well? Well, interesting conversation here and query here, Sharad, because we have somebody who has a 5 to 7 year horizon, has already waited patiently to see the upside in the ITC investment. which has done fabulously well. You know, even if you invested at the start of the year, you'd be sitting on a 40% profit in terms of gains. So what would you recommend from a 5 to 7 year horizon when it comes to ITC? What are the levels that you could probably see on the stock and the fundamental growth drivers, Sharad?
See, 5 to 7 years, obviously it will remain bullish because on an average you can expect 15-17% kind of growth. The only flip side is that the cigarette business could see some headwinds, but right now I don't see it in the short 5 to 7 years. For India, at least, I don't see any headwinds there. Till we get into a mode where we are a developed economy, I don't think there will be any fall in consumption or something like that. And the FMCG business should continue to grow very handsomely the way they have pulled up the brands and everything. So long term, it's a very bullish idea that you can hold on to. I think over the next 2 years, I think for maybe it is fully valued somewhere around 500. I think no, I don't see beyond that. A demerger trigger can cause some upside, but not more than that. Very long term, I think there is a possibility that you could be looking at something like a target of somewhere around, say, 700, 750 over that period. That is quite a possibility. And regarding the strategy, I think you keep it simple. Whenever you get it at around 25 times last 12-month earnings, buy more of it. And the valuation goes up to somewhere around 35 times trailing 12-month earnings, get out of the stock and get back. Since you are a 5 to 7 year horizon, I think if you just adopt this strategy, maybe you would gain some profit out of it.
Okay, that is how you could approach ITC. But let's also get to our next query now. Kasa writes to us from Hyderabad. He holds 160 shares of JK Lakshmi Cement at 721. The stock is currently at around 680. So he is seeing a bit of a loss over here. He says he is a medium-term investor and wants to know whether to hold or sell. Rajat, what is your call on JK Lakshmi Cement? Because, you know, through 2022, it had quite a good move. But this year, the stock has definitely faltered. So how would you look at this now?
I would suggest exiting the stock because it is testing its 50-week moving average, and the chart pattern suggests that there is likely to be further fall, and that fall might take it down to initially 600, and it could even go down to 500 going forward. If the market were to take a downturn, the JK Lakshmi would be badly affected because it's looking very weak from oscillator point of view, from the price performance point of view. So if I were in his shoes, I would have exited the stock.
Okay, all right. Well, Sharad, would you have a view?
Yeah, I think this is one of the more efficient players in the country, mostly North India based. They don't have much of a capex going on stream over the next 2 years, so that way not much addition would happen. But the valuations are roughly around $75 per ton, EV per ton. So I don't think there is scope for much of a downfall from these prices. And cement numbers should also look good going ahead because petcoke prices have come down, even transportation costs because oil prices have come down would help them. And post-monsoon, the demand revival should be very strong because we are very bullish on the real estate as well as the civil infra work that's going on in the country. So that should help JK Lakshmi Cement. And I think he can hold on for an upside of here to somewhere, say, around 20-25% from current levels is a possibility that you could get.
Okay, got that. So that is on JK Lakshmi Cement. The next query comes in from Yashank, who writes in from Bengaluru. He holds 116 shares of IEX with a purchase price of 198. So he is seeing a loss here as well. And then he's a short to medium term investor. And, he wants to know what he should do with this investment. Sharad, what would you think about this stock right now, considering that he's only a short to medium term investor and he is seeing a bit of a loss? What would you suggest and what do you think is going on? Because this stock has seen levels of nearly 300 before.
Yeah, it's been one hell of a volatile ride for the stock. But I think the recent change after which the stock saw another bout of correction around 15-20 rupees, I think that was very unnecessary. Those regulations as and when happen would take around 2 to 3 years to happen. And the stock has multiple triggers, but most of these triggers are very long-term in nature. So they might not fructify, say, over the next 2 to 3 months or 4 months, because it requires the overhang of regulatory clearances and everything. But the space they are into is very attractive. The power exchange where the trading has to happen. As we shift from long-term PPAs to cash markets, there is a high probability if some regulatory change comes there, that could be a windfall, but I don't think that's coming anytime soon. So it should be a gradual grower. The renewable energy certificate trading is something that's very attractive. Carbon credit trading is one attractive proposition. India has a dominant positioning there. So I think if something gets finalized on that part, that could be a very good game changer for this company. The gas exchange is already there. I think over the long term, the growth rates, etc., should be very strong for the company. Even power traded on the exchanges is minuscule in comparison to the developed world. But then India is not a developed country right now, and it might take some time. So we are expecting top line, bottom line CAGR, top line CAGR of somewhere around 25-30%. Bottom line CAGR could be 40-50%. And there is a possibility that the company reports with the carbon credit and renewable energy certificate gaining traction. There is a possibility that 2-3 years the company reports something like an 8 to 9 rupee EPS. Then you could be looking at a target of somewhere around 250 to 270 on the stock. But short term, I don't think you have much scope because it should remain very lackluster. But if you can extend your horizon to say 18 to 24 months, there is a possibility you could be looking at 270 to 75 on the stock.
Okay, all right. Well, that's on IEX. The stock has definitely been a bit of an underperformer, losing significantly, around over 20% in the past 12 months. Well, we need to take a short break, but a lot of queries lined up on the other side. Stay tuned. Welcome back. Well, we still have with us Rajat, Bose to answer all of your fundamental and technical queries, and Sharad Avasthi also here answering all the questions our viewers have. Let's get to another query then. We have Gurbinder Singh Bedi, who writes to us from Noida. He holds 200 shares of Nureka Limited, which he's bought, and he also has shares of SpiceJet, which he also has, and Nykaa. He's a long-term investor and says that he can buy even more of these shares going forward. He wants to know what his next course of action should be at this point in time. So, Sharad, what would you recommend to Mr. Bedi? He has a lot of investments in the broader markets. Considering that these, the mid-cap, small caps have done so well, what should his further course of action be on these specific stocks as well as maybe investments in the broader markets?
Nureka, the recent numbers have been a bit of a mess actually, because after COVID they could not ramp up the sales as they expected, and actually it's decelerated. But if you look at the products and the number of patents that they have acquired, the SKUs that they are providing and the products that they are providing, it seems an impressive list. And I think the space within which they are operating is expected to grow at a 20% CAGR for the next 7 to 8 years. And Nureka should benefit out of it. Most of it is through e-commerce only, and it's an asset-light model. But if you compare year on year, it might look a bit scary. But I think this is a space which you could term as a high-risk, high-return kind of space. And they have most of the products across various, therapies and various usage products, vitamins, multivitamins, and etc. Dr. Physio and this another product, so Dr. Trust. So these are essential tie-ups that they have. I think in the long term, this could be a very good multi-bagger kind of story that you should hold on to, but assign high risk because last 1 year, the top line has decelerated substantially. But I think if the space is going to grow at 20-21% CAGR and the product profile is impressive, there is not much of a debt overhang either. So I think you could hold on to Nureka as a very good long-term bet. SpiceJet, I think, again, they are expected to report a loss next year also. Right now, largely it's a duopoly in the Indian airline market, basically Indigo and Air India. So I think it's better you exit out of SpiceJet. If you want to stay in the airline space, Indigo makes sense, though it has run up a bit. Wait for a bit of corrections, maybe some news or something happening because... wait for a bit of correction, get into Indigo. So exit SpiceJet. Nykaa, well, the numbers could be very optimistic if everything falls in place. So I think the most optimistic number would be over the next 2 years, getting an EPS of somewhere around 4 rupees. though the consensus right now is somewhere around 2 to 2.5 rupees. So 2.5, it looks fairly valued too expensive. But if you consider for, I think, the type of growth that Nykaa can log in, the type of fascination the product basket and everything has, and the new products that they have launched, there is a possibility it could trade at somewhere around, say, 40 times. So aggressive targets could be 160 to 200 on Nykaa. But out of the three, I think Nureka looks the best place to for anyone who's going to put money for the long term in terms of the type of growth that can come in, and the product profile looks very impressive.
Okay, you sound optimistic on this one. Let's also ask Rajat what he thinks of all three of these stocks. Rajat, first let me come to you on Eureka, because Sharad was mentioning that as well. Do you also feel like this can be a good long-term story? I mean, the stock has corrected 70% in just 1 year, but do you think for a long-term investor it makes sense to keep the faith?
See, as of now, technically there is no such sign to suggest that it is going to turn around immediately. For that to happen, it should cross 412 and sustain above that. Then only you can expect that it might have reversed its course and it is going up. So my suggestion would be to continue hold on to whatever this gentleman has, and once it crosses that level of 412 or 415, whatever you think would be suitable, after that start buying, because without some kind of a momentum, if you average a stock that is lying level low, you may have to wait far longer. So I would not say get out of your existing position, but add after it crosses 412. Whereas if you were to buy Nykaa, I would say the time is now that you can actually consider buying Nykaa, because there is a turnaround. At least it's not there in the fundamentals, but technically it suggests that there is a possibility that once 150 mark is taken out, Nykaa can actually move up, and its immediate target would be something like 175 to 180, and it could even going forward go up to something like 220. So Nykaa can be bought here. He can add more. For Nureka, he should wait, and I do not track SpiceJet, so I would not comment on that.
Okay, all right. Let's get to another query then. We have Komal Parekh, who writes to us from Faridabad, holds 30 shares of Adani Green, which is bought at around 855, 80 shares of Max Health, which is bought at around 522. Medium-term investor wants to know what to do, whether one should book profits or stay invested. Well, Rajat, what would you recommend on these two?
Regarding Adani Green, I would say that it is extremely flat, even flatter than Nureka. And this kind of flat trading, it leads to an expansion in the Bollinger Bands. Basically, they are standard deviation bands, so it can go either way. So I wouldn't suggest any action on this, because if you ask me, at least from a technical point of view, I can't say whether it will move up or move down. So hold at the best. Regarding, what was the other stock? Man Infra?
No, the second stock
Max Health?
was Max Health, bought at 520.
Well, Max Health is in an uptrend, and I would suggest that you put a stop loss. You put a stop loss below 550, and you can continue to hold on. Max Health did give a very good run, but you should maintain a stop loss, because such a sharp rise that has happened. After that, if it were to fall, that you should exit at a certain level to bring in some profits to your pocket.
All right, got that. And with that, Rajat, Sharad, we're completely out of time on this edition of Your Stocks. But thank you for stopping by and taking us through all of these individual queries. I'm sure they help our viewers a great deal. We're going to leave the markets completely flat, just around 5 points in the green right now. The mid-cap index up 0.4%. Thank you for tuning into Your Stocks from the entire team. We have a closing bell coming up for the final hour of trading.